Thy rod and thy staff, they comfort me. Thou preparest the table before me in the presence of mine enemies. Thou anointest my head with oil, my cup runneth over. Surely goodness and mercy shall follow me all the days of. Good evening, everyone. You can see me at the top. I'm going to show you where I store the links to the recordings and to the presentation. Hold on just a second. Let me see if someone else is in the waiting room. I think we're all in. So in Realm, if you have access to Realm, you go to Groups, go down to Financial Wellness. Once you get to Financial Wellness, you go to Files. And these Sway, if it says Sway, that's my presentation. So this is the presentation from last week. This is a link to the video. YouTube is on YouTube from last week. And this presentation is also being streamed to YouTube. So I click on this link. And this will open up the presentation. So if you can go there, you can follow along with me if you like, or you can go there at your leisure. Most of the high points that I say will be part of this presentation. So this is Financial Wellness Online number 2. I'm gonna open this up with prayer. Heavenly Father, once again, we come before you, bowed heads, humble hearts, and joyful spirits. We come before you to say thank you. Thank you for the time, the place, and the company. Father, allow us to explore these basics in trading and investing as we prepare our minds and ourselves for what the future holds for us. Ask that you would be with each household that's represented here, Father, that you would help us to become great disciples and great stewards as we minister and lead in the kingdom. This is our prayer in the mighty name of our Lord and Savior, Jesus Christ. Amen. So once again, I'm talking about this my little money tree. I'm gonna give you a map. End of the month, a map to this little money tree, where you can find the magical water can and where you can find that magical water that you put in the can, and you pour it on to that money tree and it grows. It would be nice if it worked that way, but it doesn't. So the agenda for tonight, start out with my disclaimer. I am not a financial advisor, a stockbroker. I'm not giving you advice, investment advice. I'm not giving you trading advice. I'm sharing information. This is for educational purposes. If I call up any stock symbol, it is just for educational benefits. I'm not advising you to go and buy any of the stocks or ETFs or any of the securities that I mentioned. So that's my disclaimer. We're going to look at a homework review. Open up with some question and responses, see if there are any questions from last week or questions on anything dealing with trading or investing. But tonight we're going to specifically look at why learn to trade. Why should you even bother? We're also going to look at why you should learn to invest. When I specifically talk about what's the difference between trading and investing, I realized that was on my agenda last week and I didn't even come close to that. We're going to introduce the concepts of risk, returns, and risk-adjusted returns. Now, 789 is just a little bit of math. And then we're going to look at some free tools. Chartings, fundamentals, and news. We're going to look at a website called finviz.com. Now, this is free. You can use it without setting up an account. If you set up an account, you get a little more functionality out of the website. And that new functionality is free. They do have a elite version that you can pay for. I've never used the elite version. I've only used the free version, and I have an account with finviz.com. We'll look at stockcharts.com again, and then we will look at a website called splithistory.com. And then there'll be another time for questions and responses at the end of the presentation. So the homework. Did anybody do the homework? Take yourself off mute. Did anybody do it? Did anybody go and see how much income you earn? Well, I went and looked at mine. I went to ssa.gov, that's the Social Security Administration, and they'll show you by year how much income you earn that you pay Social Security on. And I added mine all up. It came to be $956,443. And this is since 1975. And 7 of those years, my income was 0. So that's 38 years where I actually had income, which gives me an average of over $25,000 a year. The low was 250 back in 1975, and the high was 59,303 in 2001. So that's almost $1 million. Now, while I was in the military, I got a lot of tax-free income. So I've earned over $1 million in my life. And, you know, I should have some of it around to show for it. But that's the type of information you can get if you go and set up an account at ssa.gov. And I would hope that everybody who's listening would do so. In your leisure, find some scriptures that relate to finance. Number 3, you need to determine where your money comes from and where your money goes. This is the beginning of a budget. And if you don't know where your money is coming from and where it's going, you will never be financially well. And you will never be in a position where you could trade or invest. And the last question is, what would you do if God bless you with $1.5 million? Did anybody take a look at that? If you did, raise your hand. No hands being raised. So I'm gonna assume that none of us did. But I asked the great internet, and here's the first thing it showed me. It says, what should you do with $100,000? It lists several things here. Pay off bad debt, high interest loans. Now I would switch 1 and 2. I would put money in that emergency fund and then start doing my debt elimination. Play catch up with your retirement accounts. Everybody can go get a IRA account, and you can add money to that. If you're not maxing out your 401k, then you should, at least to what the employer will match for you. Then number 4 talks about putting money in college funds for children, repairing your home, pay down your mortgage, donate some money. I'm big on giving money away. Pamper yourself with reason. Don't rush into spending your windfall. Consult with a fee-only financial advisor. There are many financial advisors where they will charge you a percentage of your portfolio every year. This website is recommending that you not use that type of financial advisor. There are some financial advisors that don't charge you at all. Whoever you end up getting your financial products from pays that person, and they put all of your money to work, and that company pays the advisor. So find yourself a financial advisor. Now, bad examples. I don't know if y'all can see this, so I'll read it to you. 16-year-old Kelly Rogers won 1.9 million pounds in a UK lottery and proceeded to waste her entire winnings on vacation, shopping, and breast implants. She now works a job to pay off the additional debt that she has accumulated. So these are bad examples of money management. The next one, Willie Hurt won $3.1 million in the Michigan lottery, ended up getting divorced, losing custody of his children, and getting addicted to crack cocaine. And he was also charged with attempted murder. When William Post won $16 million in the Pennsylvania lottery, his own brother hired someone to kill him so he could get his hands on the money. No, you don't have to tell. If you win big money, you don't have to tell anybody. And the final one they have down here is Jeanette Lee won $18 million in the Missouri lottery, but gambled it all away and ending up having to file for Chapter 7 bankruptcy less than 10 years after winning. So that's just amazing, amazing what we can do with money if we do not have a plan. So let us not be those examples of bad money management. Now, here's another quick example. This website says what you should do with $1 million. How to invest $1 million in 2020. They ask a millionaire, what would he do if he could start over? And this is a picture of his portfolio. He has 1,450 shares of Facebook, some shares of VGT, Berkshire Hathaway, Amazon, and Tesla. Those are the top holdings that this individual has. $200,000 of his money is in Facebook. Now, he said if he could do it all over again, I'm skipping down to the bottom, he would invest his $1 million. He would put at least 60% of it into a mutual fund. VTSAX has a very low expense ratio, 0.05%. Vanguard mutual funds are extremely low cost. He would put a smaller amount into an international stock market fund and a smaller amount into the emerging market fund. And that's how this person would advise you to invest $1 million. You can ask the great internet and you'll get examples, and they're all worth reading. He talks about a tool called a 4K fee analyzer, and probably there's a link in here where you could use it yourself. So ask the great internet questions is a great way for you to learn. If you have any question about trading or investing, you can ask the great internet, and you will be taken to some sites where you will be exposed to information, and you can start expanding your mind when it comes to financial trading and financial investing. Now, this third example, I'm gonna play a short video, because if I won $1 million or $1.5 million, the first thing I'm gonna do is what this video is gonna talk about.
Would you like to get the peace of mind that comes with access to multi-million-dollar FDIC insurance, combined with the convenience of managing just one banking relationship? Focus on Cedars and you can. Cedars is the Certificate of Deposit Account Registry Service. Available at thousands of banks nationwide, it's the easiest way to access multi-million-dollar FDIC coverage on CD investments. When you use Cedars, you work directly with just one bank, any bank that is a Cedars Network member. Here's how Cedars works. Let's say you have $1 million to invest for your organization or yourself. With Cedars, your funds are divided into amounts below the FDIC insurance maximum of $250,000. And those smaller amounts are placed with other federally insured Cedars Network members. So by working directly with just one bank, you can access coverage from many. Record keeping is simple. you receive one regular statement from your bank showing interest earned and other important details for all your CDs placed through Cedars. And of course, your confidential information remains protected. Also, Cedars can eliminate the non-stop hassle of ongoing collateral tracking if you are used to doing so. Invest using Cedars today. Enjoy access to multi-million-dollar FDIC insurance combined with the convenience of one bank, one rate, and one statement. Getting started is simple. Ask your bank about Cedars today or visit cedars.com to find a Cedars Network member near you.
Trying to get out of this screen, not having much success.
So what is a CD? How does it work? Is it better than a savings account? Is it better than the stock market?
Just bear with me for a second, please. I am kind of stuck here. I'm gonna stop the share for a moment. That should allow me to go in and get rid of some of this stuff. Basically, your regular account at a bank is only insured for up to $250,000. So by using CDARS, you can get all your money insured by the Depository Insurance Corporation, the FDIC. While your money is sitting there, you can go learn how to trade and how to invest. So it's going to earn a little bit of interest. It's federally insured, and you're able to take the necessary time to learn how to trade and invest. There we go. Now we can get out of that. All right, so let's get back to the Can you all see my screen?
Yes.
Okay.
I'm sorry. We can see you.
You can see me, huh? Okay. I don't want y'all to see me. Oh, God, what did I do? What did I do? Okay. Share the screen. Here we go. There we go. Now you don't see me, right?
All right.
I want y'all to see me. Oh, God, what did I do? What
We
did
see you.
You see me again. You're not supposed to see me.
I see you and I see the homework.
Huh. You see me big?
I see you little. I don't see, now I
Okay,
see,
I want to know what you see big, sweetheart.
right now, I only see the participants. Okay, I see homework big.
Okay. So, you know, if you haven't gone to ss.gov, please go and take a look at how much money you've earned. Ask the internet big questions. You'll be surprised what you can find. And I just showed you 3 examples of really quickly. Now, this presentation is available on RAM. You can go in and spend time and investigate these websites and links that I have here more thoroughly. Okay.
Okay.
Now, are there any questions before I start talking about what trading is and why you should trade, what investment is, and why you should learn to invest? Okay, so I will continue, but one thing you can think about, asking the right questions. Right now, any question you have is the right question, okay? Because trading can be, and investing can be kind of scary. When my daughter bought her one share of Pfizer, she was scared to death. She had to close her eyes to press the button to before she could buy that one share, and that didn't really cost that much money. Okay, and I told you about my wife when she was trading with had $800, and the educational place was allowing us to trade real money. It was real difficult for her to make that first trade. So ask questions now so that when it comes time for you to start making trades, you will have no fear, okay? And reach me, you can email me or text me. I love talking about trading and investing or the word of God. You can ask me any question. I really love it. And the tougher the question, the better, because that's how I'm going to learn. I won't learn unless you all ask me tough questions. And my screen has, oh, here we go. All right. Why should you learn to trade? Now, this picture shows you an example of what some people they'll set up their trading screen to look this way. In this area, they're showing that they own Dell, how many shares, and you can see green means they're making money, red means they're losing money. They have a stock graph down below. This particular one is of Google. They'll have other little tools available to them. But this is just one setup. But first, what is trading? Now, there's going to be some words in here that you may not know what they mean. You don't trade until you have a good understanding of what these words mean. Trading is a scalable, exportable, and home-based vocation that has low startup costs, low operating costs, manageable risk, and high and scalable rewards. Now, scalable means that you don't have to work more or longer to make more money. The same effort it takes me to find a position that I risk $100 in, so it may take me an hour to go through what I do to find something to establish a financial position on. And I risk that $100. The same hour to risk 1,000, to risk 100,000. You don't have to do more work to make more money. I just have to be willing to risk more of my capital, more of my money. Okay, that's what scalable means. You can easily scale up or scale down. Just risk more money or risk less money. Exportable, I mean, you can take this self-employment goes with you. As long as there's internet access and you got a computer, it can go wherever you go. It's exportable. Home-based vocation, you can do this from home. The training, the education, the mentorship, trade, invest, all can be done from your sofa, your bed, riding down the road in a car, actually, as long as you got internet access. So this is a home-based vocation. Trading is also the process of establishing low risk, high reward, high probability, low volatility, and market favorable positions in financial markets while periodically booking profits. So when you trade, you're going to be creating income periodically. Trades typically last anywhere from minutes to maybe 3-4 weeks. If you're, depending on the vehicle that you're trading, it may last 3 months, 4 months. Usually you'll get an X signal to get out in that period of time. But you are opening positions, meaning you're risking money, is going in your favor and you're making money. You get to your point, your target, or where you're satisfied with the amount of money you made, or you get a technical indication to say you need to get out, and you get out, but you are booking profits regularly. Low risk, you're buying low or selling high. Remember, low is relative, okay? It's relative, and you have to determine what is your value point. But when you're trading, low is usually about a low price, a price where buyers are attracted to it. People like to buy low and sell high. So you want to buy it when it's low. And I will, show some tools about that as we progress in the month of March. High reward means you're going to risk a little bit of money. I'm going to risk $100 to make 50, to make 100, to make 500, to make 1,000 even sometimes, okay? Depending on what tool you use, but high reward. I'm gonna risk a little bit of money with the possibility and expectations of making more than I risk, or a good percentage of what I risk. If every time I risk money, I make 50% on it, I would be happy. So if I put $100 in, I make $50. If I put $1,000 in, I make 500. The reward is the same. It's a percentage. It's typically how I manage or look at the reward. What percentage? When you look at $100 and making 50, that don't sound like much. But 10,000 making 5,000, now that sounds even better. But it is the same reward from a trading perspective. High probability means that historically you've seen that these market conditions usually result in the position I put on going in my favor. It's going to make money for me in the time frame that I've seen in the past. And if I'm wrong, I get to say, keep most of my money. I don't lose all my money. That's what capital preservative outcome is about. Okay, high probability means this has worked time and time again. I've seen this work time and time again. Low volatility means the market variations are low enough that I can still determine as a trader what status the market is in. For instance, if the market is up 4% one day, down 6% the next day, up 10% the next day, drops down 12% the next day, I have no idea what the market's going to do. That's high volatility. I'm using a daily chart. I'm using that as the chart that I'm gonna trade off of. That's too volatile. I may have to go to a smaller time frame, which will cause me to be in and out of trade in a quicker time frame. But low volatility means that the day-to-day or the period-to-period, I may be using a 4-hour chart or 1-hour chart. Those variations are small enough to where I still have a technical picture of what the status of the market is. And the last one there is market favorable. When you hear on the news that the Dow lost $2 trillion in the month of May, money is never lost, okay? That money changed hands. It went from when the market goes down, somebody's making money. Somebody's losing money. When the market goes up, somebody's making money and somebody losing money. On every trade, there's a loser and a winner, okay? So when the market drops by $2 trillion, that $2 trillion just changed hands from the people who thought the market was going to go up to the people who thought the market was going to go down. So when we put on a trade, we have to have this understanding of various asset classes that show that the market is favorable for the particular security that I'm trading to move in the direction or move like I needed to move to make money. That's what market favorable means. For example, the dollar. Let's say the dollar is going down. So the money is leaving. People are taking money out of the dollar. That money is going to go somewhere. They're going to put it somewhere in the market. Let's say they're putting the market in bonds. I see bonds going up and I see the dollar going down. It would be foolish for me to go buy the dollar. The market isn't favorable for the dollar to go up. It would be foolish for me to see bonds going up to go and try and sell bonds to make money, okay? The market is favorable if the dollar's going down and bonds are going up. The favorite for me to be is to buy the bonds and sell the dollar, okay? So we have to look at other asset classes and related equities and make sure that the movement of those supports the movement that I hope to see in the security that I am trading. So once again, it's a process of establishing low risk, high reward, high probability, low volatility, and market favorable positions in financial markets while periodically booking profits. So those words need to mean something to you. And until you know what they mean, you should not be trading real money. You should be practicing real money. Like, you know, was this market volatile? Was it low? Let me go see, you know. So I'm throwing some words out at you in the hopes that it will let you know that we have to learn a lot of stuff before we start risking real money. We talked a little bit about low startup costs, and this is being self-employed. If you are a trader, you're self-employed. If you don't go and sit down and trade, there is no income from it. Okay, so this is a form of self-employment that has low startup costs and low operating costs. You need computer, laptop, tablet, or smartphone. Most of us already have this. You need internet access, and there's lots of places where that's free, but most of us typically have internet access, or our phone is a hotspot. Brokerage platforms. In the 21st century, most online brokerage firms are free. You need a financial plan and you need a trading plan. You have to write this and you have to implement it. Before you start risking real money, you need a financial plan that you are executing and a trading plan that you are comfortable with, and you make a commitment to trade by it. So why learn? I told you what trading is, but so why learn? It allows you to put your money to work. So your money is working for you instead of you working for your money, okay? But trading is short-term. It's short-term only. It allows you to develop a stream of income that's free from government entitlements, free from working for others, and is free from externally imposed limits. You can make as much money as you're willing to risk, okay? Especially as your expertise gets better. Like for me, you know, my retirement check is a government entitlement. I served in the United States Navy for a certain period of time, and I'm entitled to a retirement check. I will start drawing my Social Security check later this year. I've been paying into Social Security those 38 years I've been working. I paid into Social Security, and I am entitled to my Social Security check. Now, the government, they could change the laws, and my Social Security can go up or down, and my pension could actually change. But trading depends just on me. Now, you do have to pay taxes. You do have to pay taxes on when you trade. There are taxes on capital gains. But it's you know, the money has been doing the work, and you just have to pay the taxes on it. Now, number 3, trading will allow you to fund your legacy, complete the funding of your retirement, jumpstart any mentoring activities that you want to do, and you can pass on. Once you learn how to do it, you can teach your grandchildren and great-grandchildren, your children, okay? So these are 3 reasons why I think it's beneficial for us to learn to trade, put our money to work for us, develop another stream of income that is free from a lot of stuff, and allow us to fund our greater visions, okay? Our greater visions. And this is, now we do have to spend some time to educate ourselves and to gain some skills to be successful at trading, but it's well worth the time that you're gonna spend learning, I believe. So these are an overview of why you should learn to trade. Now, what about investing? Investing is scalable also. It's exportable, it's home-based, low startup costs, low operating costs, manageable risks, and high scalable rewards, the same as trading. It allows you to put your investment capital to work for you in low risk, high probability, high reward, long-term, okay? That is a key difference, long-term financial exchanges. Investing will also allow you to create streams of income that are free from government entitlements, free from working for others, and free from externally imposed limits. Investing enables us to accumulate dividend and or interest-paying securities and other income-producing investments that become your legacy. So trading is going to help fund your legacy, but your investment become your legacy. They become your retirement. Instead of funding your retirement, your investments become your retirement. and they fully fund your mentorship activities. And the investing allows you to pass wealth to the second and third generation. So trading, you're building skills to trade, and you can pass those skills off to the next generation. But if you have investments, you pass that's wealth. You can give that wealth, pass that wealth on to subsequent generations or charities of your choice. So this is an overview of what investing is and why you should do it. So the difference is, I probably talked about these already. Trading is short-term, investing is long-term. Trading usually involves risking 1 to 10% of your trading capital at any one time in any one security. So let's say you have $10,000 in an account. You're not going to take that whole $10,000 and put it in one stock. And then you could lose the whole thing, okay? Trading, you're gonna limit yourself to 1 to 10% in any one security. Whereas investing usually involves risking a lot more money, 10 to 50% of available investment capital at any one time in any one security. Investments tend to use more money than when you trade. You know, you may trade 1,000, you may have a $10,000 account and put $1,000 into one trade. But if you're investing, you're buying that yield, you may take $5,000 and buy $5,000 worth of stock at the 5-year low, paying a yield that you are happy with on a company that probably is not going to drop their dividend. And that's the difference. Your investment positions will probably tend to use more money than your, especially your non-paper assets when you're investing, like real estate. You're going to invest in a rental property, you know, that's going to cost you $100,000, $200,000. You're going to get a loan, you're going to put some money down, but you're building wealth. That rental property is going to start paying you rental income. So trading is about acquiring income. Investing is about building wealth. So there is another difference. Investors are trying to build wealth. Trading, you're trying to acquire income that can help you build wealth. And trading, you're usually going to pay higher capital gain taxes than investing. And this makes investing more tax friendly. So if you hold a investment for more than a year, you pay a low capital gain. You're going to pay, depending on how much money you make, you know, you could pay nothing, or you could pay, I think it's 15 or 20%. This link will show us. Let's take a quick look at this link. It talks a little bit about the capital gain taxes for long-term capital. There's a little table down. Here we go. So in 2019, if you were single and you made less than $39,375, you pay 0 capital gains tax on your gains, your long-term capital gains, okay? 0. If you made from 39 to over $400,000, you pay 15%, and 20% if you made over $400,000, okay? So you see how that goes. That is typically how long-term capital gain goes. The rates are going to be much lower than the short-term. Now, short-term capital gain, you're going to pay whatever tax bracket your ordinary income falls in. That's what you're going to pay. So it can be from 10 up to 37%. Whatever the tax bracket that you're paying on your ordinary income, that's what you're going to pay on short-term capital gains. Now, capital gains is a good thing, okay? If you have to pay capital gains, that means your money has been working for you. I wish my capital gains tax was $1 million a year. That means I probably made $10 million, okay? So having to pay taxes is not this terrible thing if you're paying them on capital gains. It just means that your money has been working for you, making money for you. So These are some differences between trading and investing. Short-term versus long-term, larger amounts of money that you're putting into the positions. One's about income, the other one is about wealth, and investing is more tax-friendly. I hope I'm not going too fast. I'm hoping to leave some time for questions at the end. So risk. What is risk? When you think about risk, think about what's the worst case scenario that could occur if this position moves against my desired outcome. So let's say there's a stock at $10 a share. I buy 100 shares. I have risked $1,000. Now, if you go to the great internet, some of them gonna tell you, well, if I buy it at $10 and I put a stop to get me out, and if it drops to $9, I'm only risking $1. So it's only $1 a share is my risk. $1 times 100 shares, I'm only risking $100. Well, the stock could close at $10. The next day it could open at $5. And you just, and your stop is gonna sell it at $5, and you just lost $500. So just because you got a stop that's $1 less than where you know, to define your risk, that's a desired risk. But risk from the perspective that I believe is, what is the worst thing that can happen? If you buy a stock at 10, the worst thing that can happen is they go out of business and you lose everything. So risk is, now there are some securities that if you risk, you put on a position, like a futures, you put on a position, they're gonna freeze a certain amount of your, the cash you have in their account. I think the E-mini sits around probably $13,000 for one contract. And let's say you got $25,000 in that account. If the E-mini moves against you greater than the amount that they've frozen, you can lose more than you have in your account with certain securities because of how they're leveraged. They can move against you and you will have to pay more than you already have in your account, okay? So when you trade certain entities, even though you got $25,000 in the account and they freeze a certain amount of it, if the next morning you wake up and it's dropped a whole lot and you were hoping it would go up, you may owe them another $50,000. Okay, so understand that some securities, due to leveraging, you risk more than you have in the account. With stocks, that's not the case. Unless you are doing, you know, you can lose more than you got if you short a stock, but we'll get to that later, okay? But if you're just buying stocks, the amount of money you just spent is what your risk is from my perspective, okay? So look at the worst case. The primary job of a trader and investor is to be a risk manager. That's your primary job, is to manage your risk. As a risk manager, you're not able to control the sources of risk, but you're able to control the impact to your capital by setting up some rules. I call them money control rules. You do control your money. You decide how much money you're gonna put into the position, when you're gonna do it, and what you're gonna buy. You control your money. So you tell the market, this is the amount of money I'm willing to lose in this position. If you're not willing to lose it, do not put it in the position. Okay, and that's the hard thing about trading. I got $10,000 in an account. I want to trade it all. No, you don't do that. You want to be able to lose everything you got in the market and still have money left over to continue trading. So you never put more than 50% of it. If you got 10,000, I'm never going to have more than 5,000 in all my positions. So you have that control. You know, I've never risked more than half my trading account. And then you have a control based on individual positions. You may have 5 stocks or ETFs that you have position in, and I won't risk more than, let's say, $1,000 in any one of them. So that's a 10% in any one position and for 50% overall. So if I got 5 positions, all 5 of them go against me and go to 0, I still have $5,000 I can trade. Half of that is $2,500. So I would risk $2,500 now. So your job is to control your money. That is how you manage risk. That is how you manage risk. And you should never risk more than you're willing to lose. My wife is down here. Oh, you see me? Y'all see me? You're not supposed to see me. Oh, gosh, I'm so sorry. Okay, so she's gonna let me know if she can still see me. You're supposed to see my desktop. So that's what risk is how much money can I possibly lose in this position? Now, if you ask the great internet about risk, there's all different types, okay? These are the sources that's going to cause the position to move against you. So I asked the great internet, and we're going to look at a couple of lists. Each list you go to is going to be a little different. Since when you invest, you're exposed to different types of risk. Learn how different risks can affect your investment returns. Market risk. That's different types of market risks. Changes in your investment due to economic declining in value because of economic development. Okay. Equity risk. Equities go up and down. That's just how markets act. They go up and down all the time. Interest rates. Interest rates can change, and that can impact certain securities like bonds. Bonds are extremely sensitive to interest rate. Bank stocks, extremely sensitive to interest rate. There are others, and you'll learn as you immerse yourself in financial education. Currency. We live in this world of where we are all interconnected. These global corporations are impacted by currencies. For years, Apple kept billions of dollars overseas because of the currency and also the tax implications of bringing that money home. Okay, so those are some market risks. Liquidity risk. Some things don't sell that quick. A very liquid access, you can change it to cash just like that. You know, most stocks, there are some stocks that are illicit, and you can tell. We'll as we mature and you run into questions about liquidity, ask me, and it becomes very obvious when you see the chart of a liquid stock and an illiquid stock. But imagine like real estate. Sometimes it takes a year to sell a piece of real estate. That's the liquidity risk. And during that year, interest rates could change, and that could impact the how much you can sell your property for. So that's liquidity risk. Concentration risk. You got all your money in one thing. Credit risk. Reinvestment risk. Inflation can impact the value of your investments. Something they call horizon risk. This COVID is one of those horizon risks. There's some things that unforeseen events and may force you to sell when you didn't want to. Longevity risk, outliving your savings, foreign investment risk. So this particular website, lists 9 types of risk. Well, let's go check out this other one. This guy has 10 types. He starts out with market. So we got equity, interest rate, and currency, liquidity, concentration, credit, inflation, horizon, longevity, foreign risk, call risk. This is something on bonds, but you don't need to know the specifics of this right now. Just realize that different types of securities, some have a risk that others don't, okay? social and political risk. Something could happen in the country and your high-paying foreign was paying you big dividends, the government could nationalize that company and your dividend could go away. Now that rarely happens in developed markets, but it can happen in emerging markets, okay? So, and I'm telling you, there are other types of risks, but the bottom line is when you put $1,000 out there, you're risking the whole thing. And if you're not comfortable risking the whole thing, don't put it out there, okay? Now, believe it or not, there is a way to insure your stock positions and ETF positions. You can insure, you can buy insurance on your car and your house. You can also insure your 401k and you can insure your investments. There is a way to do that, but that's a topic for another day. That's a way to insurance, you transfer the risk from you to somebody else. You just have to pay a premium for it, okay? But as a trader or investment, your primary job is to manage risk. That is your primary job. So I'm gonna go run and look at the agenda right quick. We did the homework review. I covered why I think you should learn to trade, why you should learn to invest, the differences between the two. And we've just completed risks. So now we need to do returns. So when you invest money, you're hoping to reap a profit in return. So I'm gonna do a little math off to the side. The first return I want to talk about is return on capital. So if you have a trading account, let's say you have $10,000 in that account. That is your capital, $10,000. You park $10,000 over there, and at the end of the year, you want to know how much money did I make on my 10,000. So let's say you made $200 a month. So that's $2,400 for the year. Your return on capital is 24%. Now, if you did this every year, people would be after you to manage their money, because 24% every year, believe it or not, from very few investors manage to do that. But let's just say you did. You traded. We're looking at trading right now. You're trading and you're making $200 a month, and off of that $10,000. That's return on capital. Now, all capital is all the money you got in that account, because if it's in that account, you're not using it for other things. Now, return on risk is a little different. You may have a rule that says the most I can risk is 10% of my capital. That would be $1,000. So during the course of the year, you were making $200 a month, but you were only risking a maximum of $1,000. You still made that same $2,400, but the return on your risk is huge. It's 240%. Because you're only risking, though, if the worst thing that could have happened to you one month was you could have lost $1,000. But you were making $200 a month using no more than $1,000 of that 10 grand that you have. You made the same $2,400, but your return on risk is 240%. And people would be knocking down your door trying to get you to trade their money for you. They'd be like, look, trade my money. If you can take 10% of my money and make the same 24% that the first person was, every month they were taking that whole 10,000 and risking it to make that 24%. Well, you come along and you use just $1,000 and you made the same $200 a month. So you both made the same amount, but you only risk $1,000 a month. The other person was risking $10,000 a month, the return on capital. So the return on capital is the same for both accounts. One person was risking $10,000 and you're only risking $1,000. And that's what leads to the last term, risk-adjusted return. You talk about how much you risk. You risk 10% of your capital to make that 24%. So anytime your return, which is 24% in this case, is greater than the percent that you risk, you are a great trader or investor. If you're taking 10% of your capital and you're making more than that 10%, you are considered a great, I mean, you're great. You're great. People will flock to you. Now, I've never done anything like that. I had $10,000 in an account once. I grossed $88,000 that year. My commissions and fees was over $4,000 though. So my take home out of that was 40%. I started in March and December, I had made, $4,000. Now I took the 10,000 out and I kept trading the 4,000 and I end up giving it all back. Okay. All I got left is $24.76. But that's because I don't follow my own rules all the time, and I'm getting better. I'm getting better at following my rules. But it is possible to use a portion of the money you have in your account and make a decent return. And then as your confidence grows, so now you've made, $2,400. So now you got $12,400 in that account. And you say, I'm gonna raise my maximum from 1,000 to 1,250, let's say. And you continue to ramp up. And as that account continues to grow, eventually, you could be putting, if it doubles, now you can easily just do the exact same thing you've been doing, you just risk more money. I got 20,000 in here, I'm gonna risk 2,000. And you can eventually take that first 10,000 out. And now all you got is the market's money in there. And there's a school of thought that you can be a little more reckless. I wouldn't advise that because you may, get into some bad habits. To continue doing what was successful. Continue being a risk manager and managing your risk so that you can return more than because you're going to lose money, okay? Every trade you put on is not going to make money. Every investment you make, you remember, I'm a buy yield when you're making an investment. What is the yield? Every dividend paying stock you invest in, some of them are going to cut their dividends. And you're going to have to sell at loss. You're going to have to sell at a loss. It happens. That's the cost of doing business. The goal is to have small losers, small winners. Every now and then get a medium-sized win, and every now and then get a really large win. What you don't want to have is a large loss. And you do that by never putting more money in than you can afford to lose. Okay, you limit your downside by risking. You don't risk all your money. You never risk all your money. That way, one trade cannot wipe you out. Or everything you got in the market, the Dow has a terrible day and people go selling like crazy and you're down and your emotions kick in. So what? I'm managing risk. I could lose everything I got in the market and I still got money to trade. Why? Because I'm a risk manager first, okay? So this is just a little overview on returns. We have to merge risk and returns together. We have to balance risk and return. And one of the worst things that can ever happen to a trader It's the very first trade you put on, you know, you double your money. You make 100%. You think you know everything. You know, you followed all the rules the first time. Oh, you knocked it out of the park. You know, you made 300, 400%. Now you think you know. So you upsize the next one. You know, that one works for you too. The third one works for you. You put, oh man, I know how to do this. You put everything you got in that fourth one and boom, you lose it all. Okay. So we have to follow our rules. And as our trading capital grows, we risk more because our trading capital has grown, not because we're getting greedy and we want to make more money, if that makes sense to anybody. So I'm gonna run back to the agenda right quick, make sure, because last time I didn't do everything I said I was gonna do. So we've done risk, returns, and risk-adjusted returns. I'm gonna pause right now and see if anybody has any questions about anything I've covered. Now, the reason I'm going over stuff like this before, you know, we start, I'm showing you, oh yeah, you need to buy right here, use this technique, is because if I wished I had learned about risk first. I wished I'd learned about money control, risk management. I wished I'd learned those things first instead of how to put the trade on and where to go and what broker to use, all that stuff. And just, I remember the first time I sat through a class, I didn't get it. I sat through it in August. I paid $1,500 and listened to this guy scream at us from 7 o'clock to about 11. And a lot of people left at 11. And then after they left, he starts talking about the really good stuff. I didn't get it though. I went back in February. I said, oh, I got it this time. I went home, I opened up my account, I put my first trade on, and I made, it was called up a buck and out. We want to buy it at $2, and once it goes up to $3, we get out, up a buck and out. And I bought it in the morning. By the time I got home, that thing was gone. I made that money, and I just knew I knew what I was doing. And I didn't, because I didn't understand risk, returns, risk-adjusted returns, the difference between trading and investing. And these concepts, once you get them down, will help you have a long life as a trader and as a investor. Since there are no questions, I will go on with looking at a free tool. So we're gonna look at finviz.com first. It is a very good website. It's free. They do have a premium version that I have not used. It gives you a wealth of information about stocks and ETFs and sectors and industry groups and the market and news. If you get an account, now you can use it without an account. If you get a free account, you can even use their portfolio tool and act like you bought a stock at a certain price, and you can see how well it does, okay? That way you can keep track of, you know, it's a way to do paper trading using the computer. So finviz.com. So this is what it looks like, the homepage of finviz.com. It's going to show you what the Dow did. Each one of these little candles represents 10 minutes of price action. The NASDAQ and the S&P 500. The little blue bar here is the relative volume. And it just compares today's volume to the average volume over the last so many days, okay? It also gives you, these little green bars shows you advancing and declining stocks, new highs and new lows. These are sentiment indicators, sentiment. Above the, see a lot of red here means most stocks are below their 200 moving average. 50 more stocks, 56% of stocks are above their 50% moving average. We had 103 new highs today and 34 new lows, and advancing and declining issues. So these are tells you is the market conditions favorable for trading or investing. It gives you some idea. It gives you this little, these are the S&P 500 stocks. All this green you see kind of sort of says, yeah, this was an up day. You see a concentration of red here in healthcare and over here in consumers. But this color can give you the flavor of the market for the day. They give you the top gainers, losers, new highs, overbought, a lot. You click on these and you'll get more information about that particular stock or this group of stocks, okay? It has some signals. It can tell you which stocks are showing certain signals. These are the last 5 news items. Talks about important events for the day. Initial claims is about unemployment. Continuing claims. These news events can move the market, and they show you which ones are going on today and what time they're going on. Something called insider trading. When insiders buy or sell, it could indicate, you know, that this is a good time to buy or a good time to sell. Okay, but you got to go study insider selling before you start using something like this as a let me go buy because this insider is buying. And then you get some futures information. Okay, over here, major news. You see that Uber is up 11%. And if you scroll over some of these items, you get a little small chart of price action and volume. Like here's Apple. Earnings release. Earnings is one of those catalysts that causes stocks to move, okay? A lot of stocks will move into earnings. They'll go up into earnings. And that is a strategy that can be used to trade, is to, you know, look at a stock 3-4 months before earnings and, you know, look for a certain technical setup. If it's going up, it's going to move up into earnings, but you always get out before earnings, okay? A stock can report great earnings and drop like a brick. It is hard to determine what a stock is going to do. A certain word in an earnings release can spook big investors. So you need to be wary of holding, unless it's about dividends. Now I'm talking trading. You don't want to trade through an earnings announcement. But if I bought Exxon at a little under $37, as long as they don't cut that dividend, I don't care. I'm gonna ride it for years, hopefully. Okay. So there's a little link here that you can click on and get a little video that will give you some insight to the website. Now they've updated the website since this video was made, but it still has some good information in it. That's just on the home page. Up here, you can put in a stock symbol. Let's say everybody loves Apple. And now we're going to get a large graph of Apple. This is a daily chart. I can look at an intraday time period. Oops, maybe I can't. See, I got to give them some money to do that. We don't want to give them any money. I can look at a weekly chart. In a weekly chart, each one of these bars represents the high of the week, the low of the week, the open, and the close of the week. So it's a summary of here's the low on this red candle, the tip of this is called a wick, the lower wick. The tip represents the low of the week. The upper wick, the tip represents the high of the week. Since this is a down day, the open is up near the high. It opened up here and it closed down here. So each candle represents 1 week of price action. And then the monthly chart, each candle represents 1 month of price action. Oh, what's he saying? Oh gosh, there's some questions in the chat. Shame on me. Hold on a second. Let's see if I can find the chat. I'm gonna have to stop the share for a moment. Okay, so what age was I when I first started trading? Oh, okay. Let's see, that was 2005 when I went to my first class. 2006, I started trading. So that ought to make me about, what, 48? 2006, 40. Yeah, I was 48 years old when I put on my first trade. And question, so I must have an emergency fund before investing. That is true, okay? You must, I would recommend having an emergency fund and having all your credit card debt, consumer debt paid off. You know, you can have a car loan, you can have a mortgage, you can have a student loan and trade, because the trading income can help you pay off those. The interest rate on those tend not to be as high as credit card and other types of consumer loans. Okay, you want to retire your debt. You want an emergency fund, retire your debt, and once your emergency fund gets to where it's full, now you can start setting money aside for trading and investing. Okay. All right, so let's go back to sharing my desktop. And you know what? Y'all don't need to see me. That's what I need to do. Now you can't see me. Now down below, you're going to get a lot of information, fundamental and some technical information about the stock. 1 hour is like, I like dividend. It's going to tell you the dividend. Apple's dividend is only 1.0%. They pay $3.08 a share. Now, some of these ratios will mean something to you as you learn more about the stock, okay? Cash to share, book to share, optionable. I only consider optional stocks for investments and trading because primarily I trade options. You can trade stocks, but like Apple closed at what today? $303.74. Okay, that's for one share. To buy 100 shares of Apple, you need $30,000. If you learn to trade option, you buy one Apple contract, and it allows you to control, to reap profit and gain from the movement of the 100 shares. And depending on how you structure it, it can cost you, you can structure the option trade on Apple where it can actually cost you, $100 to benefit from the movement of 100 shares, okay, up to thousands of dollars if you like. But I prefer using options because stocks can be expensive, okay? But you can trade stocks. There are people who trade them and they trade them successfully. But options are how you can insure. There's an option called a put option, and it gives you the right to sell a stock at a certain price. Like if I bought a $300 put option on Apple, and it could expire a year from now. If Apple dropped down to $100 and I still own that put option that I bought at $300, I can sell Apple for $300. Even though it's at $100, I get to sell it at $300, okay? So that's the options allow us to insure our stocks, but don't worry about that right now, okay? We're far from insuring using options, but I require any stock I use to be optional. There's lots of information here. You need to go to this website and start looking at these terms. And if you don't understand them, ask the great internet or ask me. I'm available for one-on-ones where you can ask me anything. And I would love to answer individual questions in one-on-one sessions. ROA, return on asset, ROE, return on equity, ROI, return on investment, margins. Some of these I know what it means, some of them I don't, okay? The next area here are about what analysts say. On May 1st, UBS reiterated their buy recommendation, and they have a target on Apple of 325. Well, we're already over their target, right? That's kind of funny. But maybe on May 1, it wasn't there. Then you get all the news associated with the stock that we put into this little box. A wealth of information in finviz.com about this particular stock. Now you go to the next tab, which is news. This is market-wide news. They have blogs and they have news agents. Some of these want you to pay money to read the article. They let you start out and then they say, oh, you need to get an account, or you need to get an account and pay me. But I sort it by view by source. Okay, view by source is how I sort it. And I want to show you one in particular, Trader Feed. You should start reading Trader Feed, even if you don't understand what it says. This is some of the best trading information I've ever read. And if you click on him down here at the bottom, he has a whole plethora of information available. He's been doing this for years. And he has this book out there that it's a free book that's on the web. But this guy does a very good job of explaining about markets. He talks about who he is and what he's done. So let me go back. I probably went through that a little quick. I sort by source. I scroll down. He's the fourth one: Bloomberg, Reuters, BBC, and then Trader Feed on my screen. And just start reading these. You may not understand it, but the day will come that you do. And it is a wealth of information. And he has little links. Click on those links. And then you can go back and read the old stuff. He's been writing since 2005. But I find his writings to be insightful and will move you more quickly to the mindset necessary to be successful in changing markets. Okay, Trader Feed, and his name is Brett Steenbarger. But anytime I look up and the market is going down really bad and I want to know what's going on, I go to FinViz and I come here and I view it by time. I come in here and I look and see if I can find something, you know, that move the market and make note of it, okay? Now, I do not trade the news. I am aware of the news, but I mostly look at price and a few select indicators to determine what I'm going to do in the market. So screener, I like let's say I want to see all stocks that dividends over 10%. I want average volume. I like it to be over 1 million. And I want them to be optionable. It's telling me right now there's 125 stocks that meet those requirements. And, you know, here they are on 7 different screens. I can look at those. And I can look at them in different ways. Here's a snapshot. Will show me the chart, some little information, and some news. Here's the dividend, 17.29%. Okay. But that screener, you can screen by many different ways, many different things. And you need to go in, these things some of them should come to mean something to you. You should know what current ratio is maybe. sales growth quarter to quarter. Some of it may, you know, as you study and figure out how you're going to invest, many of these parameters will become meaningful for you. And you can use FinViz to screen stocks that are out there in ETFs and narrow down what you need to focus on. And there are also some technical screening that can be done in FinViz. That screener. Maps, it's a visual thing. It's a visual thing. S&P 500, that was on the home page. Now, the size of a square indicates its market cap. The bigger the square, the larger the market cap. Like Amazon, Apple, and Microsoft are up there toward the big ones. They're the biggest three. And then some of these, as you scroll over them though, you will see a little information about what you're looking at. Look at the chat, In order for me to see the chat, I have to drop out of my share. So, chat.
Sister Renee, so ask your question out loud.
Okay, good evening, everybody. Are ETFs the same as stocks?
Okay, so ETFs are not the same as stocks.
Okay,
Stocks are issued by a company, a single company. And they issue a certain number of them, and that number's out there, and people are buying them and selling them. Now, companies can do second and third offerings. They can, you know, years later, they may want to offer some more. But it is representative of one company. When you own a share of Apple, you own a piece of Apple. ETFs, the most famous one is the SPY, which mimics the S&P 500. The owner of that ETF goes out and buys the stocks that are in the S&P 500. And then they issue these, they're not shares like stocks, they're actually units. They issue these units. And those units price is based on the stocks that sponsor owns, okay?
okay,
And an ETF can issue as many units as they want to. When more people want to buy the SPY, they issue a whole lot more. When a bunch of people are selling, they actually will take them off the market, okay? So stocks have a fixed number of shares that are out there. Every day you hear about a company buying their shares back to reduce the number of shares that are out there in something called the float. But ETFs, the ETFs can have they can sell an unlimited number of units. Stocks have a fixed number unless they do subsequent offerings to increase that number. Okay. The ETF value is based on the underlying stuff that sponsor owns. Like there's an ETF called GLD. They go out and buy gold.
okay,
They're supposed to have enough gold to back every unit that they got out there. And when you buy a unit of GLD, if gold goes up, GLD tends to go up and follow it. Okay.
okay,
So they're ETF, now they trade throughout the day like a stock. An ETF is a mutual fund that trades throughout the day. Mutual funds are the same.
okay,
The fund owner goes out and buys a whole bunch of stuff and sells, you buy shares. They can sell as many shares as they want to. The mutual fund can, just like the ETF. But mutual funds don't trade throughout the day. You have to put your order in before the market closes, and you don't know how much it's going to cost until after the market closes. And they see where all the stuff that the mutual fund owns settles at, and that becomes the price that you bought it at. Okay.
okay,
So a ETF is a mutual fund that trades throughout the day. just like a stock. And some of them have options. Some of them are what's called shortable. But ETFs are passive, meaning the sponsor of the ETF, the SPY, is not trying to outperform the S&P 500. It will mimic the S&P 500. The owner of a mutual fund, they're always trying to outperform their benchmark. They're trying to be better stock pickers than their benchmark, whatever their benchmark may be. Okay, there are some mutual funds whose benchmark is the S&P 500, so they're trying to actually do better than the S&P 500. But ETFs are passive instruments. They are meant to allow you to experience the ups and downs of their, of what they're trying to, their underlying, which would be the S&P 500 for the SPY. So if the S&P 500 goes up 3%, the SPY typically goes up close to 3%. It mimics it very well, okay?
Okay.
Now, since an ETF is based on a whole bunch of stocks, one stock in the S&P 500 having a bad day is not going to drive the SPY way down.
Mm-hmm.
Whereas if you own Apple and Apple had a bad day, you're going to, so you have that single stock risk. Whereas an ETF, you have a whole bunch of other things making up the makeup. So, so that's some of the differences between an ETF and a stock.
Okay.
I personally monitor a basket of ETFs and I buy options, or I establish option positions on those ETFs.
Mm-hmm.
I used to do individual stocks, but they just got so crazy. And it's so many of them, it's too many of them. And now ETFs, there's more and more ETFs coming out every day. It's getting crazy too. But I use ETFs, and for trading, I trade options on ETFs.
Okay.
There are ETFs that mimic real estate, gold, silver, gasoline, natural gas, tech stocks, emerging markets. There are ETFs for every type of mutual fund that's out there for sure. And in any sector of the market that you want to, you feel like medical, there's ETF that tracks hospitals. I think it's IHS,
Mm-hmm.
which allows you to benefit from the movement of all those hospital stocks that are in that group.
Okay. All right. Thank you.
Yeah, so a future section, we will go over what is a bond, what is an ETF. It stands for Exchange Traded Fund. Now, the bigger name, an ETF is a ETP, Exchange Traded Product. There's ETFs, which are Exchange Traded Funds, ENS, Exchange Traded Notes, and then probably some new ones coming out all the time. Those are the two that I know about.
Okay.
The Exchange Traded Note, the sponsor does not go out and buy the stock that is trying to follow. He does not own anything.
Mm-hmm.
He just tells you that if the S&P 500 goes up 3%, I'm gonna raise this ETN 3%.
Okay.
And your faith is in his credit worthiness. Okay, so an exchange traded note moves just like an ETF, but an ETF actually has stock that's underlying it, or whatever like in the case of gold, they actually got gold.
Mm-hmm.
But ETNs ain't got nothing. But the good name of the sponsor own an exchange traded note, and it went up 20%. And I wanted to sell mine. The guy who sponsors says, you know what, I can't cover all this. There's a more of a risk with ETNs than there is for ETFs because there's nothing underlying an ETN.
Okay.
Okay.
All right. Thank you.
Let's get back to my screen share. I'm almost finished.
Okay.
So go to finviz.com and just click on these things. There's lots and lots of information. Some it'll let you do, some it won't because it's going to say it's premium, but go and take a look. Portfolio, you need to have an account. The account is free and it allows you to put in stocks like you buy. So I'm gonna log in here so we can take a look right quick. So I acted like I bought gold April the 26th, 2019. I bought 100 shares of GLD. This is an ETF. I bought 100 shares. And what? I made $4,000. It's up 33% since I bought it, or act like I bought it. So this is a good way to do some paper trading or investing. Now, this isn't going to reflect the dividends that you get. It's not going to tell you anything about the dividends that you get. And I did something called a short sale on oil. If you think something is going to go down, you can sell it short. On April the 26th, 2019, 100 shares. And it says I made, what, $8,000 on that particular position. So this is an example of the portfolio tool.
Okay.
Futures, which we'll learn about this month. I'll tell you the difference between a future. A future is one of these things that you can own it and lose all the money in your account and then some. And then there's the biggest market in the world is the foreign exchange. It is huge. Every day, $60 trillion moves, changes hands, and it changes hand in the foreign exchange market. It dwarfs all the other markets combined. You know, the bond market in America is bigger than the stock market. I couldn't believe that, but it's true. The bond market is bigger there are more bonds than there are stocks. There's more money tied up in bonds than there are stocks. Okay. But the currency markets, the foreign exchange, is the largest market on the planet. And it moves, you know, we got so much money. Like, think about the stimulus checks, $2.2 trillion. They just printed up just like that. And they're talking about doing it again. You know, just blows my mind. But you and cryptocurrencies, they even have cryptocurrencies, okay? So a lot of information on finviz.com. And my time is up. I need to show you the other two. Shame on me. I don't like that. I gotta do better. Got to do better with y'all's time. I do apologize. I didn't get to show you splithistory.com again, or what I wanted to show you in stockcharts.com.
It's okay.
So I hope y'all have questions for me. The next session, I'm gonna wait and see if I get any questions because I will roll them into what I want to talk about.
Okay.
But I do want to touch on what Sister Renee asked, start explaining the different types of things that are out there for you to trade or invest.
Mm-hmm.
The pros and cons. They all have pros and cons. But the methodology is the same. You buy low and you sell high, or you invest for yield, like a bond.
Mm-hmm.
If a bond is going to pay you a certain amount, usually every 3 months.
Okay.
So you buy that bond and it'll have a rate, a coupon rate. Let's say it's paying 5%.
Okay.
And you paid $1,000 and it's paying 5%. And the interest rate environment is at, let's say that the Fed rate that you hear so much about is at 3%. If the Fed rate goes up, let's say the rate goes from 3 to 6.
Mm-hmm.
Now, you know, those new bonds are going to be worth more, right?
Right.
6%. The Fed rate goes up, all interest rate go up with it.
Mm-hmm.
Bond you got has now changed. If you wanted to sell it, the value has changed. But if you buy a bond and hold a bond to its maturity, it's going to pay you the interest it said it was going to, regardless of what the Fed rate does. So when you're talking about bonds changing, if you buy a bond as an investment and you're willing to accept that rate of return for the life of that bond, you bought a 5-year bond and you were going to get 5% a year for 5 years.
Mm-hmm.
long as you get your 5% a year for 5 years, I don't think you should even think about selling it. Me personally.
Okay.
But we'll talk about that's one thing I'd like to talk about next time, the different types of securities that are available for you all to trade or invest in. And
Okay.
we'll look at a couple of maybe a trading strategy. Maybe I'll show you a trading strategy, the most basic one that I know.
Mhm.
That's what I'll do next week.
I
Those
definitely want to talk about them bonds too, Elder Frank, because when my sister had her son back in the 90s, he's like, I think 30 something now, whatever. Somebody gave her, she had a lot of saving bonds. And so when
Mhm.
my son was born, she was saying, yeah, you should get some saving bonds, just keep them until you get ready to go to college. But and when I'm trying to purchase saving bonds, it's like that. I don't know if it kind of, and you're saying that bonds are still in existence, but it's like, you know how you used to be able to go to the bank and just get them
Right.
and
So
just hold on
saving
to them?
bonds have changed.
Right, right.
You pretty much, there's a certain website. You're not going to be able to buy savings bonds from a broker's platform.
Right.
But lots of companies and cities and countries issue bonds. You can get them, during the initial offering, and then a lot of people sell their bonds in the secondary offering. But saving bonds are not as easy to get as they used to be. I'm gonna have to go do a little research to see where you can get saving bonds, because I had some
Okay.
bonds, and I cashed mine all out in the 80s.
Right.
Um,
That's what she did too. When he got ready to go to college, she cashed them, and I mean, she did really good. But at the end, it's just like I had a bond, and then, I'm wondering if she had held on to it. But we'll talk next time because I could go on and on about this.
all right, and also look, you can set something up with me where you and I can talk about the specifics that you want to talk about.
Okay. All right.
Available for one-on-one. Just we'll talk and we can set it up.
Yes.
I bought
All
some
right,
of those
so
savings bonds too in the 80s and sold them in the 90s. Cause usually they're like half price
Right.
when they mature. You buy it for 100, and when it matures, it's 200.
Right.
Hello, Corey. How are you?
Good.
I'm glad to hear that.
So I want to close with a short prayer.
Okay.
Brothers and sisters, would you pray with me? Let us be the ones that scatter, yet increase more. Let us be the generous souls that will be made rich. Let us be the ones that water, that we will be watered also. Let us be the ones that do not withhold, that blessings will be on our head. Amen. And that's adapted from Proverbs chapter 11, verses 24 through 26. I want to thank y'all, and I hope to see you next week.
All right. Thank you so much. And thank you for doing this. I didn't know if you were going to do it again. And I got so excited. I forwarded your email about the Zoom to my sister in South Carolina. She wasn't able to. My other sister had surgery today. So she's, kind of dealing with that. So, but I did invite her. So, when the other sister heals, both of them have expressed interest. But in the meantime,